All right, MMXM. Okay, this is called the market maker model. Okay, and the X in the market maker model stands for either buy or sell. So typically, what you'll see is you'll see a B here or an S here. Okay, market maker buy model with a B, market maker sell model with a S. So once you see this model, you'll never be able to unsee it. Okay, always looking for a market maker model. And these appear in every time frame. Now, that's going to confuse you. You're going to be like, oh, what if we're in a buy model in this time frame, but a sell model on this time frame? Okay, that can happen, and it does happen all the time, but you're not going to be able to understand that without screen time. So, again, there's two models: market maker buy model, market maker sell model. Okay, MMBM, MMSM. So the main thing you have to understand is hopefully you watch my liquidity video in the basics section, but the main thing you have to understand is how the market moves from internal range liquidity to external range liquidity or vice versa. So from IRL to ERL or to ERL to IRL. So if you go back to my video about internal and external liquidity, just understand internal liquidity is liquidity inside the range, and external range liquidity is liquidity outside the range. So like right now, I mean, earlier, I mean, this would have been your external liquidity right here. And then like this would have been your internal liquidity. So you have to understand that, all right? If you want to understand how to trade a market maker model, all right? So, um, wrong wrong tab. That was FXG play. So this is the market maker buy model right here. All right. This model, okay, is not you doesn't have to be word for word. It does not have to be exactly followed like this, okay? A lot of people think they go to the chart and they're like, oh, I don't see this because they literally try to copy it like word for word, okay? Like I'll show you what I mean. They'll see this and they'll be like, where's the consolidate, where's the accumulation, where's the blue? Like they'll like be like, where's the blue square, whatever it is, and they'll try to copy it exactly. This can be the case, but typically it's this is just like a representation of what it kind of looks like, but it doesn't have to be the case right here. Okay, this does not have to be exactly followed. Okay, this is just a general kind of curve you'll get, and you'll kind of get a couple accumulation, a couple distribution phases, but they don't have to be right here. They could be all the way down here. It just depends. Okay, this is the market maker sell model. All right, all credit to ICT, obviously. Okay, this model again, like I said, is not religiously followed, so does not have to be the same exact as it is shown in this picture. Okay. So the next slides, which I'm not going to be going over every single one of them, okay, will show you a lot of models. And I post, and you got to realize you're going to have to go back in the notes and study them, okay? I'm not going to be able to teach you um, every single model all in one video. I'll go over like 3 or 4. But they're all models I've annotated this past year, and they all have the same signature and price, but they're a little different, and I'll show you how. They all have the same curvature, and again, when you see these examples, these are just examples, but I'll show you how to identify them using internal range liquidity and external range liquidity after the fact. So I'm going to show you them first, and then I'm going to show you guys how to actually identify them. So again, identifying an MMXM took me screen time. The thing people misconcept, or the people think people don't realize, is they think they have to catch the whole buy model. Okay, they think, or the whole sell model. Like they think they're supposed to know when it's going to start here, and they think they're supposed to know when it's going to end here. I typically only know when it's going to start or end on the second half. So like either here or here. That's when I know. I don't know it's a market maker sell model here. I have no idea. I mean, maybe you can anticipate it to be a sell model, but you never know until we actually get the signature and price, like the market structure shift, inversion, fair value gap, whatever it may be, until about 25% or halfway through the end. And then this is the trade you're trying to catch right here. Okay, if that makes sense. So I'm going to not try to identify both sides of the curve. Okay, just a second half to keep it simple because that's what we want to do. I have predicted full models in the past, but it doesn't happen very often. So this is, I'm not going to actually go over this. Maybe I'll come back to this, but all you should know for this is if you're basing price off a 1 hour fair value gap. Okay, so let's say go to the 1 hour fair value gap right here. So we reject this 1 hour fair value gap. You should be entering and trading based off the 5-minute time frame. So 1 hour PD array causes the 5-minute market maker sell model. Obviously, this whole thing is a sell model, but if you want to get entries, what I recommend doing is you now go to the 5-minute off of this hourly, and that's how you're going to be trading. You're going to be looking at 5-minute structure, 5-minute PD arrays if it's off the hourly chart. Now, if it's off like the 4 hour, you'd use the 15-minute. If it's off the daily, use the 1 hour, weekly, 4 hour, monthly, daily. So hopefully that makes sense. And then 15-minute PD array, you'd use the 1-minute chart. Okay. So these are interchangeable, right? 15-minute, 1 minute, 4 hour, 15-minute. So here you can see an example where we have 2 stages of accumulation, and then 2 of distribution and redistribution. So if I go back to the other slide, you can see it's not the same thing right here. There's only 1 stage of accumulation, but sometimes you can get 2, sometimes you get more of that. And do you know like that these are perfect accumulations or reaccumulations? No, you don't. Okay, I mean, this is obviously redistribution. I mean, some people would argue this redistribution and then this, like there'd be 3 here, but it's the general area, it's the general concept. And what a market maker model helps you do is find the ending drawn liquidity, which is usually some sort of initial consolidation. So you can see we consolidate here, and then that's when the model begins, and then we come back to the original consolidation. All right. So that's the main idea you're looking for. So here, okay, you get your initial consolidation up here, and this doesn't always have to be initial consolidation. If it's like equal highs, I still count it. Initial consolidation up here. Okay, we sweep liquidity here. Come back down. We inverse this for a rally gap. I would probably, again, I probably would not enter here. When I actually made this, I didn't trade too many inversion models I didn't trade the inversion model at the time, but, you can see we get our smart money reversal down here, and look at this. Notice what this is. Very clean inversion here. Singular inversion. It sweeps very fast. And the thing, why is this model so good? This was actually a monthly fair value gap. So this was a monthly fair value gap that we were in, and that's your external range liquidity. So if you're trading based off the monthly, or which I usually don't do, that bigger, higher time frame PD array is your external range because it's outside the range, and we're bouncing from it. And then what'll happen is we'll deliver from that and then go back inside the range, which if you're in a monthly chart, any of these highs according to a monthly would be internal, even this one. However, on like a 5-minute chart, this may be the external range, but you're trading it off a monthly fair value gap, right? So if I go back to this slide, if you're trading off a monthly fair value gap, okay, you just got to know all the 5-minute highs and 15-minute lows and highs in between the daily and monthly are all internal. So this would be internal, not external. But if you're on like the 5-minute time frame, this might be external. But you're not trading it based off the 5-minute time frame, are you? You're trading it off a monthly fair value gap. So we know if the market has to go from IRL or ERL to IRL or vice versa, this would be your external range liquidity, and then we'd be going back to our internal range liquidity. Now, the thing that really initiates the start of this model or the start of the second half, which is what we're trying to figure out, is the market structure shift here, as well as we violate this inversion very, very cleanly. It's a very clean inversion, and that's kind of the thing that starts or initiates the model. And then this just gives us more confirmation. We come inside here at 9:30. New York accumulates, and typically the New York session is the session that will accumulate to go back up to the original consolidation. And then we get a second stage right here, and then the afternoon ends up delivering. But again, it's all like, I really look for a textbook inversion or a very strong market structure shift at the bottom of the range inside the monthly or daily fair value gap or whatever we're in. So this one, we had buy side to the left, and this was actually internal buy side. So this was a high inside the range, and this was external. So this one isn't annotated as well, but we go from internal, and then this is probably external according to whatever time frame you want. I'm not going to go over this. I don't like this one, but it still has that kind of curve to it. And you can still see it has that market structure shift at the start. We swept buy side. It also has an inversion fair value gap right here that we break. Another inversion fair value gap here that we break. Another one we break here. And you're going to see this candle is like, okay, this is the fireworks. This is where everything starts off after you see a candle like that. Okay, this one, another one, we have internal range buy side, right? It's not outside the range. You can see this is probably external if I had to guess, or probably higher. So we take a random high inside the range, and then this looks to be outside the range. You can see there's nothing to the left here. This is the most obvious one. This is probably the external liquidity on like the 4-hour daily time frame, because this is actually the 1 hour. So this would be your external. This would be your internal. And the market, as we know, goes from internal buy side to sell side, external. Okay, this is external. Okay, because it's outside the range. And you're going to see very nice signatures of price here. We got our distribution, messy distribution here, and then our accumulation here. Okay, so yeah, it's a general curve. Okay, I'm going to go to another good one. So this is another good one. So we hit another internal buy side. Notice how we don't hit the highest high here, okay? Because that's external. And the market typically does not go from external to external. We'll go from internal to external. So we have another internal range liquidity. We know it's inside the range because it's not above these. We still have more liquidity above. We take this, and do we know we're going to get this displacement in a live time? No. We're just waiting for the reaction here. So you can see we wait for the reaction here. We see that we don't displace above it. And then we see we get a bearish fair value gap that's respected nicely. And then what happens is we break these key fair value gaps here, and we have equal lows here. So like it's a sell model when you see those kind of equal lows. We get another breaker block here. I'm not going to teach breaker blocks in this course because I decided I'm not going to. And I don't really use them that much. But again, this is typically the lower sell. I typically do not take this. This might be the trade I'll take. Like this is like the second stage distribution. This is what you want to take. And typically I only take it if there's an inversion setup. It looks like here there was not an inversion setup, which is fine. So yeah, but another really nice internal to the external, and we know this is outside the range because there's not really any liquidity here to the left. So it's external liquidity. Okay, another one, just really nice curve here. Another one, really nice curve here. This one again, this is internal range liquidity. There's still liquidity down here to the left that we didn't take. So this is the internal range. And where does price go back to? Back to the external. And it looks like this is the highest high for a while. If we look to the left, there's nothing to the left. So it's, again, internal to external. And what initiates this market maker model? Well, what initiates it is the market structure shift we get here over this high, and also inversing a fair value gap at the same time. So those are the two key things I look for when looking for a model like this. And then for like a extra confluence, I like if we deliver from some sort of major like bullish fair value gap or maybe bearish fair value gap if we were at the high. That's like a bonus. But typically, as long as some set of sell sides taken and then we inverse a fair value gap, you start looking for whatever the external high is. Okay, another one. This one actually, the smart money reversal was an SMT, and I go over SMTs at some point in this course, but this was an SMT, which is nice. Another one, another SMT with the S. I'm assuming this is probably fair value up to the left as well. Another one here. And yeah, you can see like most of the examples are similar regarding the curves. And remember, you don't really know it's a sell model here. Like all this price action is hindsight. But when we start getting this and we start violating everything to the left, that's when you know. Okay, especially like these fair value gaps here, which are very obvious. Like these would be very, very obvious that, okay, we violated these. This has to reject now because we have nothing else in our way. We have this in our way. But by that time, we're so far in discount, we're probably going to have to draw on liquidity. We're not going to bounce like from a 0.90 fib, right? That just doesn't happen a lot. If we're that far lower, we usually go to sell side unless we have some sort of SMT. So my goal, like I said, is not to spot the whole curve. It's to spot the second half of the curve or the second 50% of the curve. So I wait till they form. And then based off of whether we hit internal or external liquidity, that's when I look for my target, okay, of internal or external. So if I see, give me a second, I have to cough. If I see us delivering from an internal range liquidity to external, to like just somewhere, but I see we're coming from internal range, well, then I'll look for that next internal range, okay? And that's that. The delivering from the internal is usually hindsight, but it's not hindsight because I know we still have to go hit the external, which is not usually hit yet. So you must identify where we're coming from, and then you target the opposite liquidity pool. So if we're coming from ERL, you target an IRL. If we're coming from IRL, you target ERL. So this is a great example. So we got internal liquidity here, external liquidity here, external liquidity here, another internal liquidity here. So in this example, what you can see first happens is we have equal lows, which again are a great liquidity pool, okay, right here. And we take the liquidity inside the range, we purge it, okay. What do you notice about this? We don't really get a lot of displacement, do we? And then what ends up happening is we go back up, we take out the external high, and we know this is external because it's outside the range. And remember, you don't know we're going to take out this external high until we inverse like this fair value gap here. See this right here? So we have an obvious fair value gap here. We inverse it. Now that's your chance to, okay, now I'm going to go to lower time frame. And I'm going to look for a trade up to this external because I know price is delivering from an internal range liquidity and also violating another fair value gap. And I guess you consider this like a market structure shift as well. And then again here, price takes some sort of internal liquidity. We did not take the highest high, right? This is your external now. This was your external. This is your new one. So we take an internal high, and then you can see what happens. We start to violate all this to the left, and then somewhere down here, that's when you go in the lower time frame and look for like a little retracement and then get in and hold down till the external liquidity. So again, I know some of you guys are probably going to be like, what? How do I identify that? But it's going to take time, and I'll show you a few examples as well. So again, the start of the model is usually hindsight, and then the second part is usually where you're trying to catch the live entry. So again, you're entering after reversal happens and you're taking it back up to that internal or external. Okay. If the chart does not make sense to you, okay, if these charts do not make sense to you right here, okay, I'll show you like the most easiest one to identify. So the easiest possible market maker to identify is when we get a sweep of liquidity inside a fair value gap and bounce from it. This is the easiest one to identify. Okay, the reason why is because we get a sweep and we're delivering off of a higher time frame fair value gap. And this, like I said, is the hindsight part. Okay, this is the hindsight part. This, when we start to inverse this stuff and you know we're coming off an hourly fair value gap, you know we have to go to whatever high was made before that fair value gap was created. And it was the high up here. Because if you go on the hourly chart, you're not going to see all these candles. You're just going to see this high formed. If you go on the 4-hour chart, you're not going to see any of this. You're just going to see a nice red candle, and this is going to be the high. So if we're delivering off a fair value gap with internal liquidity inside, and we swept both and also bounce off the fair value gap, that means there's a good chance we go back up to that external liquidity. Okay, and this is the part you're trying to catch, like somewhere around here. As long as it's the right time, as long as it's New York session. So, again, it's very important to understand this. You're not going to catch this part, but when the New York session comes or when London session comes, this is the part you're trying to catch. And then obviously you're not holding past this. The only way I'd ever hold past external liquidity is let's say this is a 1 minute market maker model, yet we still have 4-hour equal highs above. Maybe I would hold a runner then. But if we don't have anything above, if we don't have 4-hour equal highs or an obvious intermediate term high above, I typically never hold past the external range liquidity on a market maker model. But again, this is the easiest one to identify because we bounce from a fair value gap and take some sort of liquidity, so we know we have to go back to the highs. Okay. Same thing with this. This is the hindsight part. Okay, and then once we get this and then this reaction, this is the live time part you're trying to catch in lower time frame. Why? Because we hit some sort of internal liquidity, also reacted off a fair value gap, so the market's going to want to go back to the low that was created before making that move up. Okay, and this is the market maker sell model. Again, a lot of the other ones were cleaner, but it's still the same concept. We're delivering from some sort of internal that reacted off a fair value gap, and we're going back to the external. So you're not going to understand this. I never really understood market maker models for probably like 6-7 months, and then they started coming a little easier to me. So I just kind of kept watching the market for testing, kind of matching what I knew and learned from YouTube, and then eventually I was like, okay, well, this makes sense. I'm seeing this in live time, etc., etc. So it takes a little time, but make sure you understand this is the hindsight part. The reaction from this is hindsight. Yes, you can anticipate it, but I typically try not to. I just react. And then this is the live time part. So, all right. So I'm going to go to a live chart and I'm going to show you a few examples. So if we go to the hourly here, all right, if we go to the hourly here, I don't know this is a market maker sell model and all this price action. I see we tick out buy side. I see the market comes up to a weekly fair value gap and we kind of reject this weekly fair value gap. So what does that mean? If I see us reject a weekly fair value gap, well, let me go to my little handy dandy cheat sheet over here. So we rejected a weekly fair value gap. That means I'm going to be looking for a 4-hour short. Okay, 4-hour model. Okay, so go back to the chart. We rejected a weekly fair value gap, so I'm going to be going to the 4-hour. All right. And then that's where I'm going to look for my short entries. So you can see the market does give us a short, but we never retrace into it. So what I would have liked to see happen is something like this, but that never happened. So what does that mean? Well, that means you can go to the lower time frame and maybe look for another short. The only possible short I see here is, I see this one right here. Okay, this is the only one I see. So price closes under that. We have an intermediate term low, which again, if you watch my liquidity video, I always talk about these. We have an intermediate term low and we close under and we don't hit the intermediate term low, which was good. We actually retest this before hitting it. So that was nice. We retest it, then go hit it. So that would have been a short. And then what I would do is I would keep looking for short because we have another intermediate low here and we displaced well through this. So this means this is probably coming. Okay. So this is a 4-hour market maker model off of a weekly time frame. Okay. You get your accumulation here, some more accumulation here. Okay. And this is, you probably get your distribution here in an hourly time frame if I had to guess. Let me check. Yeah, so you get your distribution here in hourly. Okay, that's your distribution. And then you don't get any distribution up here. You don't get any second stage distribution in the hourly here, which is fine. You're not going to get it every single time, but this would have been probably a nice short. That would have been your second stage distribution. I think what happened is I think we got an ADS, and I think this was happened to be an SMT as well. So I think that was a SMT right there, which is why we didn't get it. But you can see, like, if I know the market just hit an external range of liquidity, meaning the highest high there is, where does the market like to retrace back to? Internal range of liquidity. Well, where is an internal range of liquidity on like the daily time frame? Internal range of liquidity would be right here. Okay, it's the on the daily time frame, it's the last low inside this fair value gap. So I think that we're going to go back to this daily internal range of liquidity because we don't have any more daily liquidity here. We're delivering off a weekly external, and the market's going to want to go price back to this IRL here. Where's external range liquidity? Right here. So we're not going to hit this unless we get something like this. Let's see. The only way we'd be able to hit this if we create some new internal range liquidity. Let me use the path tool. All right. And then we take it out, and then we could go here. Okay, so we would form, if we were to go to this on the daily, we would have to form some sort of new internal range of liquidity and then take that out, then go down. But for now, because we're delivering from ERL, okay, which would be here, we're likely to go back to IRL, which is right here. Okay, so what would the confirmation be on this? Well, the confirmation is if we inverse this weekly fair value gap. Okay. So that's the confirmation to go back to this IRL. But you can kind of, sometimes you can guess and be like, oh, well, even without this confirmation, if we're delivering off a weekly fair value gap, does this make sense to fill or does this make sense to bounce? It probably makes sense to fill. But again, obviously we want to wait for the confirmation. So That's how we're going to keep ourselves out of losing trades. But this would be the target down here, and it's also a pretty abnormal wick, so that's also nice as well. All right, so that concludes the end of the market maker model video. I could go over these all day and just show you examples of, okay, we hit internal range, we're going to external range. But the best case scenario of you figuring out how to do this is back testing them. So like, and just another example here, we hit this internal range, and then we go back to the external range that made this high. So we get a low, it makes an internal range high. We take out that high, but we don't take all these highs over to the left, right? This is the external right here. And then price comes back down to external, which is outside the range, right? It's the only low in sight. And then we created a sell model here. So that's really what you're looking for. Remember, the best models are the ones that deliver off a fair value gap. So I think this one did deliver off a fair value gap, if I believe. Yeah, it did. And just to add on to this, you're probably like, well, Dodgy, how do you know we're going back down? Well, I didn't. Not until we got our short set up and the big fair value gap was here. So I only knew we were going to go back down once this was violated. So you can't guess this is going to be a market maker sell model here. Only if this is violated, then you know it's your sell model. Then you look for your short in here, and that's when you target the external range. So this is not hindsight, right? The hindsight is if I were to say, oh, I knew this was going to be a sell model here, but I didn't. Not until this was violated, I didn't know. So just keep that in mind. And at the same time, again, we're delivering from a daily fair value gap. So yeah, maybe you can anticipate this to be violated because we're delivering from a fair value gap, but there's no confirmation without this inversion happening. These are the best models when we deliver off of some fair value gap, and this one did. So remember to pay attention to that. Yeah, that's the market maker model video. You can probably find a lot of more content on this on YouTube, but no YouTube video, no single one is going to help you. It's going to be this video that's going to accelerate your process. Same with YouTube, and it's going to be all you from there. You're going to have to just plot these out a decent amount, and you'll get better as you go. So probably took me a year to master these, but yeah, it would be great if this played out because it would just show the importance of, okay, we hit external, where we're going to go. Where are we going to go? Internal. So I hope this does play out, but obviously the weekly fair value gap would be confirmation. So that's the end of the video. I'll see you in the next one.